You have heard a couple of these English-spoken episodes.
Yeah, great episodes. Yeah, definitely. The recent one with Chuck Carnival was, I know him from Seeking Alpha, and very rational person, and the way he approaches, I would say, value investing, but also coupled with some quality aspects. Really interesting.
Yeah, he is quite a popular guy here among investors on Discord. Am I right, Kenneth?
Definitely. Just a second.
You have to excuse us. We're both tired of working, and it's quite hot in Norway. So,
Uh-huh.
Okay, let's see. Yeah, I'm in Poland actually right now, but that's fine. Okay.
oh yeah, you are.
Yeah, it's even hotter here.
It's 28 degrees in Trondheim.
That's odd or not normal, right?
Climate change.
Well, yeah. Uh, uh, since Easter, the weather in Trondheim has been the best in the entire country. So it has been an average of 20 degrees since Easter, and I'm not kidding
Wow.
around. Yeah. So
That's amazing.
we are quite lucky. I can't remember. I've lived in Trondheim for 7 years, and I can't remember the last time it has been this good, the weather, and so stable as well.
Not in Belgium.
Yeah, I know. I've been there a couple of times. It's
Oh,
rainy
terrible.
and cold and windy as well.
Unbelievable. I think it's now raining for, I would say, 7 straight months, approximately. It's
Yeah, that's horrible.
As long as the dividends keep raining in, I don't mind.
Yeah, that's true. Okay, so shall we just get going then?
Yeah, sure.
yeah.
Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten er å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene er selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapirer som diskuteres. Okay, so welcome to StockUp, episode 44. Today we have a special guest. We have the Compounding Tortoise from Belgium. He has a substack, a very important substack, a popular substack with that focuses on steadily compounding quality companies with detailed analysis of ROIC, reinvestment rate, and shareholder return. It's over 1,000 subscribers, and we're very happy to have you on the pod, Compounding Tortoise. Welcome.
Thank you. It's an honor.
Okay, so you got into investing. How?
Well, I would say basically at a young age, you look for some additional income. I was saving for a new bicycle, and then you decide to invest along with your parents. And then you pick initially, I would say, very fancy businesses, high beta stocks, companies, for example, in the biotech space. That then also depend on the results of their trial studies, etc. And then you make a lot of mistakes. You learn from those mistakes, and then you become interested in entrepreneurship, and then also basically study entrepreneurship and in the field of accounting, and then later on in mergers and acquisitions, and then you also dig deeper into some of the best companies that there are across the globe. So that is basically what got me interested over time in the stock market.
Okay, so saving for a bicycle. How young were you when you purchased your first stock?
That would be at an age of 12, approximately.
Nice.
yeah, so I was always, I would say, intrigued by sports, and then also later on finance. And then I thought, well, maybe I can combine the two. Initially went well, and then all of a sudden, of course, you have to make a decision, choosing between sports and academia. So then, going ahead with finance, of course.
The funny thing is, when I asked around on X, what kind of guests would you like us to invite to this podcast, and a lot of people tagged different kind of investors. Uh, I saw also that a lot of people recommended your Substack here on our Discord, and we are quite quality focused people, retail investors here, and that should be a quality stamp, I must say. I've read some of your stuff to prepare for this podcast, but I've actually gotten to know you mainly by you communicating with the community, and as well with the people that follow you as well. So it's quite impressive what you've done in so short in such a short time. Because if you could please tell us a little about yourself for the listeners that don't know you, where are you from, how old are you, etc., and what's your inspiration going forward? Because you're quite young, am I right?
Yeah, correct. So I basically turned 24 recently. um, and then, basically from Belgium, as you mentioned in the introduction. And at the beginning of the year, I thought, well, maybe I should start a Substack on investing and sharing some insights into quality growth investing, some information on M&A, because I had the fortunate to I would say research some M&A deals in 2022, and then again you learn a lot just from practice. You're able to meet a lot of new people, which is, I would say, probably the most important element when it comes to investing, is investing in companies that are run by great people, because if you don't trust the people, don't do the deal. So that is one of the elements that stood out to me also in M&A deal making, is that you have to be able to engage with many people and trust people, and learn from them. And that's basically what got me forward as well over the past couple of years. And yeah, basically at the beginning of the year, the Substack, and it's been a great journey so far. And then mid-April, I decided to do this full time, basically, because there is just a ton of reader engagement, meeting new people also this summer. So very fascinating to see that crowd grow over time. So that is basically what has been driving me since the beginning of the year. And when talking about my inspiration, Mark Leonard, the famous Mark Leonard, of course, the founder and CEO, also currently the president of Constellation Software. He is one of the most talented people in M&A and in, of course, serial acquirers. The way he runs Constellation, based on what I would say no nonsense finance. Yeah, so really a very impressive person to follow. And that's also the reason why Constellation is one of my biggest positions, and for sure we will touch upon that in just a moment. But yeah, I think Mark Leonard, what he's been doing, is just, I would say, impressive. And I would say that not many managers would share the same mindset, because I remember that he said, I think it was in 2011 in one of his present letters, that he talked about how to keep the share price in check with the fair value. And I would say that most managers wouldn't care about the fair value versus the share price, just as long as their options expire in the money and that they get some share based compensation. But Mark Leonard has always been very rational and very, I would say, focused on maximizing shareholder value for all owners, and that is something that's very impressive and worth studying. So that is where the inspiration came from, I would say. Yeah.
What is your background? Did you do you have an MBA or?
Yeah, so basically in finance, so I would say finance and management, and insurance also. So a very broad, I would say, spectrum of finance here in Belgium. Yeah.
It's quite impressive to just live off your Substack, just turning 24, and you make us look old. And I thought we were kind of the young people here. So, what is the secret sauce for succeeding so early in your life?
I would say being fortunate to meet the right people at the right time, and being patient, especially also I would say today, with a lot of inflation. I feel that people are always in a hurry also when it comes to investing to make the highest possible returns, not knowing that of course there will be periods of, I would say, disappointments, and that you have to keep going. And also I would say in life, and especially being patient and being rational is definitely, I would say, the secret sauce to succeeding in life, but also in investing, definitely. Yeah.
Yeah, because I really love your kind of brand or nick, if I may say, the Compounding Tortoise. Why did you choose that nick? It has probably something to do with long-term investing, I guess.
Yeah, so that's basically based on the fable, so the hare versus the tortoise. So the hare is of course that very explosive animal, if you like, so basically going for the sprint, and a very overconfident animal. But of course, I mean, that fable is, I would say, well known across the globe, but it was also highlighted in the book of Pim van Vliet, who is the head of conservative equities at Robeco, and he did a lot of analysis, quantitative research on low volatility investing, and basically, how is it possible that lower risk outperforms higher risk over the long term. And of course, that has to do with the fact that, with just like with the hare in that competition, very explosive, but then because of that very steady pace, that the tortoise is able to beat the hare over the long run. But of course, as I mentioned just already in the podcast as well, I mean, people are always in a hurry to make very quick gains. But I think, even today, that the low volatility anomaly is still in play, and could be even stronger than what it used to be before, because I believe that risk isn't properly priced. And so with the compounding tortoise, my goal was basically to share more insights into how to find these unique companies that have been able to generate a lot of shareholder value in the past, and should continue to do so over the next couple of years, hopefully even decades. So that was basically the reason why I came up with that name. So steadily compounding, wealth creating machines, basically.
Yeah, because both me and Kenneth saw or had an insight to your portfolio. And given the companies you have in your portfolio, we both noticed that you like recession-proof and rather nostalgic businesses. Could you walk us through some of them and what makes them kind of the long-term winners?
Yeah. Well, basically, it was also in a recent interview with Peter Oppenheimer, who is the Goldman Sachs strategist here in Europe, and he talked about super cycles in markets. So you have bear markets, bull markets, but then you also have, I would say, over a long decade long horizon, or multi-decade long horizon, that you have certain trends that basically emerge. And he talked about super cycles, and also asking, or basically answering the question, which companies are then basically able to continue to produce steady returns. And he said, well, just stick with companies that have been around for multiple decades or even centuries. And for example, one of those companies could be Otis Elevators. So I think that the Otis safety elevator was patented by Mr. Otis in, I think it was 1850. So that's a long time ago, definitely. And I cannot imagine that, someday someone will come in and say, well, let's move people up and down high buildings in a completely different way. So that's a very boring industry. It's based on a huge installed base of existing, more older elevators. So there's also the opportunity for Otis to make a lot of money out of modernization. So basically upgrading existing elevators. But also another company could be Harvia, which is maybe lesser known company in the quality space. So the sauna company, now the leading player in that industry. I think ever since I was a child, that a sauna room, you had a heater and sauna stones, and today, I mean, it hasn't much altered since. So you still have heaters. You now also have electric heaters, wood burning heaters. You now also have multi-mode cabins. So one cabin with a steam generator, and then one with an ordinary heater. So I mean, those are the kind of businesses that haven't changed much over time, and I think that they will continue to be here for the next couple of decades. So I would say those tangible businesses, I mean, you could say the same about Colgate, for example, toothpaste. I mean, they are the world leader in that space. The same with, for example, Brown Forman in Jack Daniel's Tennessee whiskey. So those are basically companies that have been around for multiple decades, and it's very hard to take their high returns and basically grow market share and take market share from those established players. So I think that the main attribute to a successful quality growth strategy is basically that you pick companies that are recession proof and that can continue to grow for a very long period of time. And I mean, it's interesting because I think last week we had the earnings report of Home Depot. Then this week, Lowe's, also AutoZone, and there were some disappointments in some of these retail businesses. And it's amazing how some analysts are very short-term focused on, again, what will the comp look like over the next couple of quarters. But you have to really, I would say, zoom out and look at that long-term track record of those great businesses. And recession proof, I mean, we've been through a lot of economic shocks over the past couple of years, and not every quality company back then has survived. So this is also, I would say, a very important key message to the listeners as well, is that quality growth companies can change over time, and something that used to be a high quality growth company can certainly be just a stabilizing quality compounder, but not with that very attractive growth that you want to see. So I do acknowledge that risk and companies change over time, which is important. So something that is now recession proof, there's a chance that it might not be recession proof over the next couple of years, and that is something, of course, that you have to, I would say, weed out and focus on just the best in class companies in that field. Yeah.
So what do you typically do to find out whether you have a rising star or a fallen angel?
Yeah, so I would say it all depends on the people in charge, basically. So yeah, again, as I mentioned already, if you don't have the right people in place, if they don't understand how to drive shareholder value creation, then ultimately that will be reflected in the share price, in the numbers, in free cash flow, or whatever. So it all starts with the people, and for sure we will be talking about Lindy versus its competitors, but just very amazing how those two businesses approach value creation differently. I think earlier this year there was a conference call of Air Products, which is basically one of Lindy's main competitors, and the CEO basically said, well, in terms of the dividend, we stick with a targeted dividend yield of roughly 2.5%. So basically, Air Products is saying, well, we are going to increase the dividend based on the yield that our stock is currently, giving to investors. And then he said, well, and if we can generate some earnings growth, then the total return will be that dividend yield and earnings growth. And then I think it was the day after that Lindy reported earnings, and the CFO Matthew White got also asked the very same question on dividend and buybacks, and so the allocation of excess capital. And he said, well, one thing I will never promise is a dividend yield. It doesn't make any sense. So that was basically very contradicting to the statement of the CEO at Air Products, and the reasoning behind it was that Lindy believes that if they do their job very well, then of course the dividend will increase. They are a dividend aristocrat, but they will also increase the capital base of the stock. So therefore, they won't, I would say, promise a dividend yield. So that is basically, I would say, two conflicting views on value creation, and obviously it makes more sense, at least in my view, to stick with Lindy, because that's a very rational view on how to allocate capital, and you just grow the dividend. But it would be not that wise to say, well, we promise a 2.5 or a 3% dividend yield. So I think that a lot of the nuances when it comes to dissecting quality growth companies is always in the details, especially now that we have more inflation. I mean, a company that is growing revenues when it's just based on inflation, then that isn't, I would say, a very sustainable growth rate if inflation starts to abate. But also in terms of cash flow performance, some companies do have very widely fluctuating working capital balances, and if the management team cannot point to the reasons why working capital is increasing, or why, for example, profitability is under pressure, then that is also, I would say, a red flag. So really you look for companies that are run by very honest people, people who know the business very well, and also I would say companies that report the earnings just on a clean basis, so unadjusted, because nowadays, of course, there is a lot of impact from technology. So the share-based compensation is one of the very trendy topics in technology companies when they report earnings and they adjust for it, and other, I would say, one-time items. And it's interesting that if you look at the very strong quality growth companies, they basically don't adjust for share-based compensation. So they say, well, it's an expense, it's a non-cash expense, but we still treat it as an expense, so it should be deducted from earnings. Whereas many technology companies will then say, well, it's a non-cash expense, so we add it back to the earnings. It will also be added back to free cash flow. But then, of course, you're basically diluting your owners, and that is not something that we like. So I think one of the very good examples of a company that is reporting its numbers in a very fair way would be L'Oreal. So I think that recently Terry Smith, so the founder of Fundsmith, he talked about how the CEO or the CFO of L'Oreal basically replied to a question related to Brazil, because there was I think it was a write-off in Brazil, and he said, "Well, what's the sense of adjusting for that write-off? It would make the earnings look better, but that would not be realistic because there was just that headwind in Brazil. So why would we even adjust for what some could consider a one-time event?" So I would say again that honesty of people in charge, and again, it should be based on common sense. And today I see a lot of risk taking, a lot of investing that is not based on common sense. But ultimately, I do believe, like with all bubbles, that will basically pop over time.
That sounds interesting. So I get this right. You find companies that have a very strong product. They have a solution for a problem or a solution for a need and a want, and they have to have operational excellence and financial track record and a management that knows what they're doing and that they're honest. So what else are on your list when you find these compounding machines?
Yeah, so I would say return on invested capital is one of those, elements, but it's also a very nuanced ratio. But I would say the best way to, I would say, succeed in the quality growth investing space would be that you look for a company that is basically, really a standout compared to its peers. So, for example, if you look at Harvia, they have an EBIT margin of operating profit margin of more than 20%, currently at 24%, and the other competitors are basically at 6% in best, and they have a return on invested capital of over 30%. But then also again, Harvia, if you look at that company, it's in the sauna space. Approximately 70% of that industry is driven by replacement. But of course, because of the pandemic, a lot of people were staying at home. They decided to build a sauna. So there was a lot of, I would say, new build driving a lot of demand, sauna rooms being installed. And then, of course, people kind of extrapolated that enormous growth. Then all of a sudden, of course, in 2022, interest rates started to increase. There was the energy crisis, the exit from Russia. So they had a subsidiary in Russia. And so sales basically went down 25%. And then I thought, well, with sales being down 25%, it's a smaller company. It will be quite tough basically for them to sustain that 20% plus EBIT margin. But they succeeded, even with sales declining 25 or maybe I think at some point it was even 30%. So that was a really, I would say, interesting insight when analyzing Harvia, is that the business, despite lapping the tailwinds from COVID-19, was holding up very well even during 2022. So looking for a very high return on invested capital versus its competitors, because those competitors were basically loss making during 2022, or barely profitable. And again, still Harvia generating positive free cash flows in each and every quarter, despite some supply chain constraints as well. So working capital was increasing at some point, higher inventories. So a lot of, I would say, external factors that impacted its performance, but still they managed to to continue to generate significant shareholder value. So I do believe that high return on invested capital is very important. The same, for Constellation, when they approach the acquisitions that they do, they are very stringent in the return criteria. So they target roughly 25 to 30% internal rate of return for the smaller acquisitions. And then they also have some larger acquisitions for which they drop the hurdle rate, from should be 20% to roughly 15 to 17%, depending on I would say the deal size. But still Constellation, compared to many others in that space versus, for example, private equity, they are still very very focused on achieving the returns that make sense. And also, I would say, also during the latest, general shareholders meeting, Mark Leonard said, well, when looking at acquisitions, when looking at returns, it's all about probabilities and letting the probabilities work out in your favor. And again, also modeling several scenarios. And that is also important. So quality growth companies, I would say, they do have, again, that very strong product, but also that very high return on invested capital. And these companies are also focused on preserving, I would say, the baseline. So preserving shareholder capital, not dipping below the baseline, and growing, every single year, regardless of the economic rhetoric. But also, I would say Hermes is another, high quality growth company, which is oftentimes, I would say, associated with many other names in the luxury space, despite the fact that, Hermes is really, it has its own league, basically, when it comes to pricing power, when it comes to controlling supply, killing two birds with one stone, basically. So high margins, but also steady revenue growth. And it's amazing that they continue to be, I would say, associated with, for example, Burberry or other, I would say, lower end, luxury companies. And again, they also have the very high return on invested capital, currently at what is it, 58% approximately, I think it was, which is a lot better than Burberry or Gucci, or even LVMH. So again, also a standout company. Same with Lindy. They have now 25%, 26% return on invested capital. If you look at their nearest competitors, so Air Liquide and Air Products, they are basically at roughly 8 to 12%, which basically means that if there is a lot more inflation, if the investment costs go up, that Lindy is very well equipped to handle inflationary spikes. So yeah, I think going for the highest return on invested capital companies is one of the I wouldn't say guarantees, because there's never a guarantee, but one of the most attractive ways of identifying a quality growth company. And just to put out another name, would be Copart, which is the online auction of damaged cars versus insurance auto auctions. If you look again at Copart, it's a 30% return on invested capital business. Insurance auto auctions, I think it was closer to 15%. Copart has been reinvesting back into the business at very high returns. If you look at insurance auto auctions, they've basically distributed a lot of dividends. They didn't grow the business. They took on a lot of leasing, so leasing the salvage yards to operate their business, which also, I would say, creates that long-term, I would say, competitive disadvantage for insurance auto auctions. So if you have the high return on invested capital company, and if that company is really standing out compared to its closing competitors, then you could make a case of a really sustainable competitive advantage going forward, even especially during crises, which is of course when you need a moat most.
They are a cannibal stock, like O'Reilly and AutoZone, kind of increasing their EPS and just doing large chunks of buybacks. Am I right? Do you prefer them doing buybacks or distributing dividends?
Yeah, that's, I would say, for Copart, it's been quite rare that they do the large buybacks. It's mostly basically to offset the dilution from the share-based compensation. I would say that it doesn't have a lot of impact. I would say that Copart has to just reinvest back into the business, and if they see an opportunity to repurchase stock, then they can do it. But I would say when it comes to buybacks, just like with dividends, it has to be rational. I mean, if you have excess cash on a pretty consistent basis, then the only thing that you have to do is distribute it back to shareholders. Of course, buybacks are way more tax efficient than dividends, depending on where you live, and of course the final withholding taxes. But there are companies, especially if you have that high return on invested capital, then there is basically no other way for you than distributing excess cash back to shareholders. Definitely. So for Copart, I would say that for the most part, they are reinvesting back into the business. There is some dilution related to share-based compensation, and then from time to time, I think that they buy back, maybe in through a tender, 5 or 6% of the float in one time. but that's basically to offset dilution from, let's say, 3 or 5 years prior to tendering, to tendering that buyback.
So I saw that your top 3 holdings are Hermé, Constellation, and Linde. They're all approximately trading at an all-time high if you look at the price action. And all of those are quite popular stocks, and I believe they are so for your list for your subscribers as well on your Substack. I've done my kind of due diligence, just screening their numbers. And how can you defend the valuations right now? And how would you try? How would you? It's kind of a difficult question because valuations is an art, you know. So how would you evaluate them at this current price at these levels? And what do you say for those who are not holding the stock but want to have some margin of safety?
Yeah, I think it's a great question. So I would say valuation is definitely also for Constellation. I mean, I think as a generalization on quality growth investing, that valuation will always be where most people say, well, I think it's not it's not an interesting strategy, and because it's always a question of, will those companies continue to deliver what they've been doing for the past several years, decades? In some cases, the multiple has expanded. For example, also for Copart, if you look at their previous multiples, Old Dominion Freight Line is another company that has seen multiples increase over time. So it's not always easy to say, well, the multiples have gone up, so that will continue, or at least that multiple will stay the same. But also conversely, I mean, there are some quality growth companies that have come down, and then the multiple has also come down. And then people say, well, maybe there is some reversion to the mean. And so then you get some additional valuation tailwind. But I would say when a multiple goes down, oftentimes there's a reason for that. So whether it is lower reinvestment rates, more cyclicality, lower return on invested capital, management being very unclear about the future growth prospects. So it's not always easy to define, well, why has the multiple come down, and is this an opportunity? But I would say, looking at Hermes, when you look at the luxury space, then even luxury over the past couple of years has had some difficult times, also because of interest rates, very tough comparisons when you look at the COVID-19, post-COVID-19 tailwind. And Hermes has been one of the most consistent performers in that space, also compared to LVMH. So they continue to trade at a premium to the market, and also compared to LVMH and Burberry and Kering, which is then the holding company, the umbrella under which you have, for example, Gucci. And I believe that the premium is justified because the return on invested capital is a lot better than what it was pre-COVID. Also, if you look at the pricing power that they have, I think that they've raised prices by 8 to 9% at the beginning of the year, which I believe is the highest ever price increase announced so far, at least in recent history. So I do believe that Hermes, they continue to have that pricing power, which is unparalleled, basically, when you look at its peers. So on the premium valuation, I do believe that that will be kind of sustainable over time. And then it's just a function of how much earnings growth do you expect, how much margin expansion do you expect, and then also how many special dividends do you expect along the way. And the way I approach valuation of companies is basically I have my internal rate of return model, which is then also shared in every deep dive on the Substack. And it's also based on common sense. So you put in your expectations, the return on incremental invested capital. So if a company is reinvesting for growth, then what is the expected return on those growth initiatives? And then you model dividend, payouts. If there are taxes involved, then you also account for dividend taxes. And then at the end, you have your, I would say, steady state, earnings figure, and then you put a multiple on that number. And I would say the best way when you talk about margin of safety, when dealing with quality growth companies, in most cases, I assume that the multiple today will, ultimately shrink, quite significantly over the next, 8 to 10 years. And that is again just to reflect the margin of safety. So, for example, when talking about Hermes, then the model is pointing to roughly 8% expected internal rate of return, so annual return including the dividends, but not the reinvestment of dividends. So if you can reinvest the dividends back into Hermes stock, then you can increase that return a little bit. So that's 8% that you can expect then, based on that input. Now, of course, people will say over the past couple of years, Hermes has been able to generate way more than 8% per annum. I mean, it's up, I think, 20% over the past, at least 20% over the past 5 years, even 10 years, because of the multiple being stable and not going down, as basically what is reflected in my internal rate of return model. So the point is, if we do see that multiple come down, then that will be a drag on performance, but then still you generate that 8% return. If we don't get the multiple compression, then you make a higher return, roughly equal to earnings growth, and the special dividends and ordinary dividends that will come your way. But that is still, I would say, remains to be seen. So again, also when you're analyzing quality growth companies, just like what Constellation is doing, then you're quite stringent in your criteria and say, what's the minimum return that I want to earn on my investment, and what's the what input does it require to reach that annualized return. So when talking about Constellation, the very same way of valuing that company. The valuation is currently at roughly 35 times net operating profit after taxes, which is basically underlying profitability of Constellation, excluding the interest costs and excluding the amortization of acquisition related intangibles. And 35 is pretty high. It's the highest it's been over the past couple of years. Again, also in my model, I assume that the multiple will go down to roughly 25 times by the end of the decade, or basically by the end of the valuation period. So at the end of the 10-year period. And also for Constellation, I mean, if they can continue to find these very good acquisitions, if they can continue to grow, if organic growth stays quite strong, which has also helped the re-rating of the multiple, is that Constellation, partly helped by inflation, has been able to post better organic growth. Then maybe investors are still willing to pay up for that growth. But one of the main difficulties in analyzing a serial acquirer, and of course it's very, I would say, a trendy topic also on FinTwit. Serial acquirers, you do have VMS serial acquirers, so basically companies like Constellation active in vertical market software. And then you also have more industrial serial acquirers like Lifco, like Diploma, like, for example, Lagercrantz, Indutrade, Technion. And the main difference between Constellation and those industrial serial acquirers is that the cash flows for Constellation over time should be a lot stabler. For example, in 2022, when we had supply chain constraints and a lot of inflation, then we did see that, for example, in Lifco, that one of their segments was also facing some supply chain constraints, and then also I would say, some customers postponing orders, and therefore also the revenue growth basically got deferred a couple of quarters. And with Constellation, you do have that very capital light business model. They have negative working capital versus industrial serial acquirers. They typically have positive working capital. So there are basically reasons to assume that I do believe Constellation will continue to trade at a premium to industrial serial acquirers because of the economics that the company has. But still, it remains to be seen if they can continue to do very good acquisitions. Like, for example, last year they did the deals with Black Knight, which were very good deals for them in terms of profitability, in terms of organic growth, but also in terms of the way they've structured the deals. So with that promissory note, basically paying a very tiny amount upfront to get those companies consolidated into Constellation, but then of course already generating a lot of cash flow out of those newly acquired companies. And very good deals, and I hope that they can continue to do it for the next several years. But also based on common sense, I mean, you have to assume for any serial acquirer that growth will ultimately slow down, and that should then also be reflected in your valuation model. But so far Constellation has been able to surprise many very positively over time. So yeah, again, let's see whether it can continue. And talking about Lindy, Lindy is also an interesting company, of course. I view Lindy as a safety net in the portfolio because they are present in various end markets. So healthcare, food and beverage. They do have several supply modes. So you have on-site customers. So basically customers who pay for the product of Lindy regardless of the industrial output. So Lindy has a secured payment that they receive, contractual payments. They also have some rentals related to their equipment. So Lindy has a very well diversified business model across the globe, and they are quite capital light if you take into account some of the business segments that they have. For example, in packaged gases, they also have an engineering business. So I would say with Lindy, it's kind of my safety net because no matter what happens, I do believe that Lindy, will survive. And this is also, I would say, one of the mantras of the management team during any conference call is basically you hear them saying, well, whatever happens, we will manage the business accordingly. And the last quarter, basically, Lindy didn't raise the EPS guidance, which was quite unusual for them because usually they raise the Q1 outlook because of better than expected performance. And I think, for the first time in 5 years, or ever since the merger between Praxair and Lindy AG got completed, that for the first time they didn't raise the guidance, and they were not very pleased with the performance. But at the same time, they were taking actions, and they said, "Well, we are going to tighten non-discretionary or basically discretionary spending, and also think of the capital expenditures that we have, and some of the investments that may not yield the returns that was that we're seeking based on where we are in the cycle." And that is also basically what you have to look for in a great company, and also when valuing companies, is that you should have confidence on the numbers and on your assumptions and the growth rates. I mean, one of the biggest foes of a quality growth investor is cyclicality. If you're dealing with a very cyclical business, a very cyclical, subsegment that you cannot model, or that is, for example, very interest rate sensitive, then it becomes quite tough to model what the exit multiple could look like or should look like. I remember very well talking to a real estate investor who basically said to me, I think it was 1 year ago, and he said, well, if the ECB, so the European Central Bank, starts cutting rates, then my real estate stock will definitely recoup some of the losses that it incurred over 2022. And that is, of course, I would say, not the way you should behave as a quality growth investor. I mean, the last thing you want to do is care about the macroeconomics. What you should do is care about what's happening to the company itself, rather than predicting what interest rates will do or economic growth or whatever. And the same with Lindy. When you're valuing that company, it should be based on common sense, and they don't have a lot of working capital swings, which is quite unique in that industry if you compare it to air products. But the cash flows that they generate are also much easier to model. So also for Lindy, I mean, the model currently is pointing to, I think it was 9.8%, which is also below my personal hurdle rate of 12%. So yeah, I think waiting for a correction to maybe buy some of those names, and you know, there will always be corrections from time to time, and it's just a matter of grasping the opportunities when they do arrive. Yeah.
Constellation does have a lot of value within the company. It's a serial acquirer which have spun off a lot of companies. Some popular ones are one of your holdings, Topicus and Lumen. Would you say, what would you say are the differences between those two? For instance, what is making you favor Topicus rather than Lumen, and what do you expect the spin-offs to generate in the future compound rate for your portfolio?
Yeah, I mean, it's an interesting question because with Constellation, and it's a very, if you look at the financials, then most people would say, well, this is like some of a zombie company or whatever. If you look at net income, if you look at the one very special items, then you would say, what what is this company worth? Then you look at cash flows, then you look at their own metric of what they call free cash flow available to shareholders, which is then basically accounting for the share that they still have in the spin out companies, which is also interesting. So yeah, I mean, a lot of complexities when looking at Constellation, so it has to click somehow if you analyze them. Now I would say for Topicus, and if you look at the recent performance in Q1, then total growth was quite light compared to Constellation. If you look at Constellation on a consolidated basis, but also Constellation standalone, so excluding the spin-out companies, then you do see that Topicus, because of very little M&A volume in the last 2 quarters of 2023, that growth was a little light compared to Constellation. So then people might say, why would you own Topicus if you can own Constellation, still have exposure to the spin-out companies, so, and also with higher growth? Well, I do believe that Topicus, just because of the mathematics, they are a smaller company, so in theory they can continue to do those tiny acquisitions with very high returns for a very long period of time. And with Constellation, they have to come up with bigger deals to continue to produce the very same relative growth rate. So I do believe that it's just a matter of size. And for Topicus, they do have some higher organic growth because of Topicus.com BV, which is basically then the company that got acquired by TSS in 2020, and then basically we then got the spin out company in 2021. So there is higher organic growth potential for Topicus. They are smaller, so in theory they should be able to grow at a rate that should be equal to Constellation's prior to, for example, 2016, which is why people say, well, maybe Topicus is the European CSI. And if you look at Lumine, there it's more difficult because they do bigger deals. Not, I would say not much M&A deal frequency. So again, very large deals relative to Topicus, which means that it's also more difficult to model when those acquisitions will come, and that could also impact valuation. So I think, personally, for me, it's more difficult to model Lumine. But if you look at the share price, I've been proven wrong so far. But yeah, I would say for Lumine, it will continue to be a very high quality acquisition company also going forward, but just with a different strategy focused on more, I would say, carve outs and larger deals. But also, yeah, because of the larger deal size, should also be lower compared to Topicus. But I would say if you look at Topicus and Lumine, then I would say the best way to have exposure to both of them is by owning Constellation, and I believe that that is still the best way to approach the CSI family, is that you just own the CSI stock itself, the mothership, but also acknowledging that because of the spin-out companies and a very special situation, that there will be some impacts from time to time. I mean, we've now got Lumine in 2023. At the end of March of this year, we got the conversion of preferred shares of Constellation into ordinary Lumine shares, which means that prior to, I think it was March 26th, that Constellation did not have an economic ownership in Lumine anymore. So because of the spin-out transaction, now they basically own roughly, I think it is 62% again, which means that they're also entitled to 62% of that theoretical free cash flow. So if you now look at Constellation over the next couple of quarters, because of the conversion, the free cash flow available to shareholders from a CSI perspective will also increase because of that conversion. So a lot of moving pieces when you look at Constellation, Lumine, and Topicus, but I do believe that always the best way to play all three is just by owning Constellation. Yeah, but if you target some higher organic growth potential, then adding Topicus could also make sense. And I believe today Topicus is trading at a slight premium to Constellation, which could then be justified because of the higher organic growth. But on the other hand, if Constellation can continue to source these very attractive bigger deals, then maybe Constellation can continue to outperform Topicus over the next couple of years. So I don't have a crystal ball when it comes to which one will outperform the other.
Well, that was very helpful insights to what for many is difficult stocks to look at because of the serial acquire specialties. But I wanted to touch in on another subject before we call off. It's been an hour already. It's been amazing. But and that is we noticed that you have several stocks in the what should I call it, transportation segment, but not the typical transportation as you would think it. You have exposure in AutoZone and O'Reilly Automotive, which provide services to the car parts and distribution and stuff like that. But you also have two very interesting Italian stocks that make boats, or not boats. That would probably be an insult to those who own them. But could you tell us a little bit about them?
Yeah, so that would be San Lorenzo and the Italian Sea Group. So basically two companies in the luxury yacht space. Yeah, I would say again, the luxury sector has been quite volatile over the past couple of years. I mean, just based on the growth rates, again, you have COVID-19. Also, for example, if you look at Ferrari during COVID-19, there was I would say, standstill in terms of volumes. And then, of course, post COVID-19, a lot of tailwinds, the lockdowns were over. And also for the luxury yacht producers, so San Lorenzo and the Italian Sea Group, we have seen a massive surge in demand, growth, revenue growth, backlog growth, and then ultimately it starts to normalize, and now we're back to more typical growth rates. I would say that this is an overlooked part of the luxury space when you want to combine growth, high quality business models, very solid balance sheets. And yeah, I do believe that also these companies can continue to, I would say, prosper over the next couple of years. And yeah, for example, San Lorenzo, which is the one that I've been following, for quite some time now. Basically the company was acquired back in, I think it was 2004 by the current CEO, Massimo Perotti. And at the time, the company was doing 40 million euros in revenues, and now we're basically headed to 900 million at the end of the fiscal year, with very strong profitability, very strong cash flows. So yeah, I would say that they do have a similar approach to, like for example, Hermes, but in maybe a smaller, in terms of pricing, a smaller pricing strategy, so 3 to 4% roughly per annum in terms of price mix. But they are also focused on that tradition of the yacht manufacturing. So sticking with the models and basically the forms that they've already introduced back in, for example, 2009. So sticking with tradition, but also being at the forefront of sustainability. I think that this week actually that they launched the first green, methanol super yacht, or at least for the hotelery, so where you basically don't have green gas emissions anymore when it comes to that part of the yacht. So basically on board of the yacht. Yeah, so I think it's an overlooked space when it comes to luxury, but I do believe that it provides very good valuations. I mean, if you take a look at their dividend yields, if you look at the underlying capital intensity of their business is very small. I mean, the only investments that they have to make, capex, is basically just on the expansion of production capacity. So when people look at San Lorenzo and also at the Italian Sea Group over the past couple of years, especially for San Lorenzo pre-COVID, free cash flow was basically zero. And then people would say, well, why is that the case? Is the company bleeding cash or whatever? But they were just reinvesting back into the business. And, today they have approximately, 50% reported return on invested capital, which is amazing. So pre-COVID, it was closer to 15%, and now it's over 50%. So that's a very nice achievement. And when talking about valuing companies and margin of safety, it's interesting to note that these companies are trading at multiples below pre-COVID levels, or at least for San Lorenzo, because the Italian Sea Group went to market in June of 2021. But for San Lorenzo, multiples have derated. The question is, why is that the case? And is it justified? But I do believe that over time, this company can also continue to grow at, let's say, a very high single-digit revenue growth rate. They continue to expand the margins, generate a lot of cash, some dividends. So yeah, maybe it could be an interesting addition to one's portfolio, because when looking at Harvia and San Lorenzo and the Italian Sea Group, then these three companies are basically the only three smaller sized companies in the portfolio. So I'm not overweight small caps because there's always a risk of owning small caps, and it has to do with the fact that sometimes their management teams are overly conservative, which could be an interesting topic for discussion. Is that when people value a company, then they look at the cash flows, so discounted cash flows. But one of the nuances is, what if the company does not distribute the cash flows back to shareholders? So what if they don't pay a dividend, don't buy back stock, but basically just let the cash, build on the balance sheet? Then you basically don't get a return out of that company because it's just building cash. So that is one of the risks of, I would say, small caps is when they are very cash generative, but the management teams are very conservative, overly, cautious, then maybe the returns will be disappointing. So that is, I would say, an important, key message as well to your listeners is that when you're analyzing small cap companies, do know that there is more volatility in cash flows, and also that when there is a lot of insider ownership or a family controlled business, that most of the time the dividend payout policy could be overly conservative, and that the company can continue to build cash, which we as shareholders cannot get our hands on, which means that the effective returns compared to our modeled returns will be a lot lower. So that is also something to keep in mind with with San Lorenzo as they go forward, is that the cash could continue to swell, which doesn't add any value, of course, to our ownership, and it won't help the multiple.
Compounding Tortoise. Thank you so much for giving us some insight to your portfolio and your great knowledge of them as well. I recommend everybody to follow you on X. I think you're quite underrated. You deserve a lot more subscribers and followers because your content is amazing. I know for a fact that you've traveled to Italy, for instance, and visited the companies that you invest in. Or did I get that wrong?
Yeah, that's correct. So for San Lorenzo, that was in 2022. Yeah, that was in May when there was the, I would say, some sort of an art exposition in Venice. Yeah, correct.
So, ladies and gentlemen, that's the due diligence for you.
Yeah, yeah, but I think it's very valuable to meet management and companies, especially when you're dealing with smaller companies, and understanding the companies and seeing a plant or whatever, so that it becomes, I would say, more tangible. And I would say, as a final remark to this, I would say, episode of quality growth investing, stay within your circle of competence. I mean, I don't have any idea, what stock will be the next winner in AI or in, any other, I would say, disruptive technology industry. So I would say focus on what you can understand and what you can model, and be rational with your assumptions. And the same with San Lorenzo. If you can visit that company and you can see the plans, and you can see the yachts, then of course, I mean, it's more tangible, and you know what the company is doing and how they make their money. And with AI or any other, I would say, more complex investment theme, then it's just more difficult to understand. So stay within your circle of competence. Yeah.
That's great advice. What made you want to talk with us? Just a couple of blokes in Norway, and you're a guy in Belgium. What made you interested in kind of approaching us?
it's very simple. I mean, hoping to add something to the community, and I was very impressed that there is a lot of engagement in your community, and yeah, I mean, it's great to see that there is a lot of, I would say, focus on proper education and hosting, many people from all around the world, and that should help many investors make hopefully smarter in investment decisions. So that is basically what got me interested, and yeah, I would say wish you all the best going forward.
Right back at you. And before you leave, you probably know this because you listened to a couple of episodes. But do you have any kind of wishes or requests for the name of this episode?
Oh, uh, it's a difficult one.
I have one in mind.
Yeah, you can just tell it. Yeah,
Uh,
go ahead.
slow and steady wins the race
Yeah, perfect.
with Compounding Tortoise.
Yeah, perfect.
You like that?
Yeah, perfect.
Then Kenneth,
Happy.
do you
I'm
concur?
happy. Yes, it's excellent. I think this is
Yes.
a really, really interesting conversation. Enjoyed it really a lot.
Thank you.
And we want you to visit us again in the near future as well, because you really have a lot of knowledge, and you really do take a deep dive into the companies that you own, and you have a nice track record, and yeah, you're just a genuine good quality investor, and that's what we all strive for.
Yeah, I think being concentrated on just a group of stocks, and yeah, that's basically what you should be doing, and understanding the businesses that you own, and sometimes there are businesses on your list that you are never going to own. I mean, I'm just looking at Dollarama, um, which is always,
Hey,
I would say,
Hey,
and continues to do.
don't go there.
um, yeah, so Nvidia is up. What is it, 5%
Right
after
now.
hours?
Yeah, that's a speculative stock. I would never, I would never poke it with a pole.
Yeah,
Oh, oh, the market is getting too ridiculous, if you ask me. But we have talked a lot about it in the podcast previously, and yeah, I'm not gonna end this episode with a bearish remark, but yeah, I think we all think the same.
yeah. I would say that also on the topic of inflation and the amount of risk taking. I mean, yeah, when you look at also analyst questions when it comes to, for example, O'Reilly or AutoZone, then analysts are very short term focused, and they have kind of, I would say, forget about the past track record of these great companies, and they just look at a 1 quarter performance, and then they say, well, maybe there are just way better opportunities outside of defensive retail or whatever. I think the same yesterday got asked on the Lowe's conference call as well. What will the pricing look like? What was the mix in your categories and whatever? So it's really amazing how people are very short term focused, and very speculatively minded. It's amazing.
Yeah, the psychology in the market is quite fascinating. Look, we wish you all the best, and we recommend everybody to follow you as well. And I'm quite certain that a lot of people in our community will engage with you here on the Discord server as well.
Yeah, perfect. Likewise.
Yeah, have a nice evening, Compounding Tortoise.
Thank you.
Thank you very
Take
much.
care.